Hey, this is Steve Ogier with ContraVest. I want to talk a little bit about the lender debt yield. We talked earlier in a previous video about the two forms of financing, which are debt and equity. And the lender uses very much the same formulas that we use, but they analyze their risk in the same way we do as a developer. So I want to talk about debt yield. So the lender, if I have this type of project where I've got 300 units and it's $2,100 a month times 12, this is my gross income, take out my expenses, there's my NOI. So the lender will be underwriting the net operating income and what is the likelihood of that income being in place. So then what they do is they analyze what their risk is. And one way to analyze their risk is to, like we do, we say, hey, we want a 6.75% return on our cost. They want to see what their risk is going to be if we don't perform as a borrower, if the project, if they have to take over the project. Lenders don't ever want to take over a project, but they are analyzing the risk if they have to. So what they do is they take my income of $5,600,000 and they do what's called a debt yield. So they may underwrite the debt yield between 9 and 10%. So they might size the loan based on a debt yield. Meaning if they feel comfortable with the $5 million NOI and they may operate under a debt yield example of 9%, then that means that the loan size that they would give us would be $56,222,000. So they would size their loan based on the NOI of a debt yield of 9%. Well, you may have another bank that says, hey, I'm going to use a debt yield of 10%. So they would take the same math and they would do it like this. And that means that their loan size would be $50 million, which would be much lower. Because if they have to take over this project, they'll have a NOI of $5 million and they'll basically own the project for $50 million, which means if they did own it and the NOI was in place, they would certainly get a 10% return on their money. So again, they're taking the same formula that we do. They're analyzing the NOI and adjusting for, well, if I give this loan amount of $56 million, that means that I'll have a debt yield of 9%, which means they will be getting a 9% return on their $56 million. Again, if the lender thinks, hey, I have lower risk, I'm going to underwrite a debt yield at 10%. Again, see how the math works here. Their loan size would be a lot less because they have a higher debt yield. So that's how the debt yield works in the lender market. And you may hear that term, debt yield. Some lenders are using it, some are not. But this is truly the way that a lender should really underwrite their risk based on a debt yield. If they had a debt yield of 7, obviously their loan size would go up substantially based on this income. Now, they might underwrite the income and say, hey, I don't believe you're going to get $5 million of NOI. I think you're going to get $4,500,000. They might cut our NOI and underwrite the same debt yield. Obviously, that would make this number a lot less. So you might hear the term debt yield. That's how lenders are reviewing their loan sizing based on that. And then we'll talk about the other way that they look at it, which is what they call a debt service coverage test on how they underwrite loans. And that'll be another video for another time. Thank you very much, and it is a great day to build apartments.